Very good evening, everyone. I hope that my sound is working properly. So let me just check the microphone settings. Can you confirm it? Because I actually unplugged the headset by accident. There's an echo. I think that should be gone now. Now it's okay? Cool. So good evening, everyone. Welcome to Admiral Markets. Thanks for joining us. We're going to take a look at trading confluence, in fact, and the key in creating an edge, maybe. We definitely think it's important. So we're going to be showing what kind of what tools we use in looking at confluence. But as always, of course, the risk disclaimer. There it is. Explaining that trading for exchange is considered high risk. It may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information on that. And this webinar is for educational purposes only. Great. Thanks for your attention on that. So once again, this is Admiral Markets. My name is Chris, and with me are Tarantula and our special guest, Michal. And in fact, we're going to take a look at this agenda and all these points in just a bit after Michal has always interesting stuff to tell us. Good evening, Michal. Michal, if you're speaking, I'm not hearing you. Maybe your mic is muted by coincidence. Is there someone else that hears Michal? Maybe it's only me. Maybe someone from the viewers could confirm if they hear Michal or not. All right, sorry folks for this small technical delay. I think either Michal is fixing or plugging in his mic or something like that, I guess. I think he's muted indeed. Well, okay, I guess yeah, Michal was muted. I don't think he realized that. But not sure if he wants to try it again by any chance, but maybe in the meantime we will just continue with explaining this until we hear from him. Maybe he'll pop in later on, okay? Until we hear from him, maybe he'll pop in later on, okay? Michal, are you there? Okay, so we'll continue then. With today's topic. Sorry for that confusion. Today's goal, trading confluence, the key in creating an edge. We're going to be taking a look at what is confluence and how to find it, why is it important, what indicators can we use for that, and some examples. We got a lot of charts coming up, so to show you real-life practical examples. Of course, that's always the best. So I think that T is going to start actually with explaining what it is.
Yeah, thank you, Chris. Good evening, everyone. Today we're going to have a nice webinar about trading confluence and basically what confluence is. Later during the course of the webinar, we will show you how you can use confluence to your advantage. And there are many nice examples, especially about patterns and confluence, even indicators. So you will see possible setups. Confluence in Forex market means that something is aligning up with something else. So it means that several technical indicators give the same trade signal. Give it an exact time, close to very exact levels, and that means that an indicator aligns with another indicator, creating a higher probability setup. Also, a confluence means that two or more events are meeting at a single place. If you, let's say, from real life examples, we can see, for example, meeting of dawn and dusk. If you know that particular time when dawn and dusk meet each other is called a confluence. Rainbow, when rain and sun meet each other, we get rainbow. Unusual apparitions which many people sometimes meet in the night or maybe close to graveyards, it's when fog meets the night. So basically when two or more things get in the same place, they create something, an effect. That effect in a Forex market is called confluence. Confluence is usually, and it should be used on higher time frames. We can only use lower time frames for entry positions. But it's very, very important to know that creating a confluence is only used on higher time frames. Because if you get a confluence signal on 5-minute time frame or lower, eventually it can be used on 15. But I would suggest always to use those later, which will show you confluence signals on higher time frames, because we can then zoom into lower time frame and find higher probability setup. Also, if there is a confluence of important numbers, fibs, trend lines, that will be a high probability setup. So it doesn't mean that we need to find two or more things that couple up. It's usually two or more events, and sometimes we can find even 3 or 4 events at a single place. In my opinion, the best confluence in Forex market is technical and fundamental analysis agreement. And that is what actually happened today after ECB announcement that the rate will be cut. I actually warned about it some 2 or 3, 4 days ago that rates may be cut and that we may be ready to a big drop, which will happen today. And indeed it was a 200 pip drop, even more. And basically that was, I spotted today, we had a nice wedge. It was a rising wedge, which is bearish sign, and that means that technical analysis for today and fundamental news event meet confluence. And basically we had some nice drops, and also we could have shorted it into retracement afterwards. So that is not very usual, but it happens from time to time. So the most important thing for starters is for you to know what is a confluence and how you can make it to do things to your advantage. So that is a confluence, and Chris will explain you why should we use confluence.
Yes, indeed. Basically, of course, per definition, the percentage or the probability of the currency acting in the way we want it to at the entry increases. If we have a supply-demand zone, if we have a fib retracement, a 61.8% Fibonacci retracement, if we have a daily or 4-hour trend line, obviously there are more reasons. The stronger that particular zone becomes, the stronger that level becomes. Maybe these 3 things in general should be sufficient for that entry to be pretty precise. All right. So in that case, the entry is well defined and has a lot of things for it to support it. So the chances that the currency will turn at that spot are relatively high. So that's picking a level, a specific level, not waiting for any confirmation or any breakouts. In some cases, you can do that by finding that confluence. That increases the chances, right? If we only have one, well, maybe the level will be respected for an hour or 2, but maybe the currency will continue to higher resistances or supports, and we'll find enough resistance and support at that level. All right. Now, of course, the fact that we have a good entry doesn't necessarily mean that we will reach our take profit. Of course, that we will have to judge in a separate manner and see what kind of realistic expectations we could have, depending on multiple time frame analysis and how many layers of support and resistance we think the currency will need to break through. Because basically, what we're always targeting is one level of support or resistance or another. Depending on how far away we target, the likelihood just decreases. If we're targeting, for example, on the euro, if we're shorted right now and we're targeting 110, well, obviously there's a lot of support for the currency to break through, and there's a lot of layers the currency needs to go and break. So obviously it's a difficult target, and the chances of that materializing are just small. Now, if we aim for the most recent support or resistance, or maybe just a bit below there, in this case the euro dollar fell a pretty decent amount below the support. I was talking about 134.20 as a target. While obviously the ECB rate definitely blasted that target out, and we went a lot lower. But of course, these events, not always can you necessarily count on them. But in any case, that target was well met, and of course that is an easier target to meet than 110. So depending on how many layers we want to target, the likelihood will increase or decrease. Now, many traders, it depends on your characteristic and depends on your psychology. In fact, what type of category you will fit in. Some people are very good at finding reasons to take a trade. Some people are very good at finding excuses not to take a trade. It all really depends on your psychology. In fact, obviously a balance will be needed, because we need to be realistic about why we take it and have good reasons, and not just make up some reasons and or just take a trade because one trader thinks that or that. Right? These are not really legitimate reasons. We're talking about solid technical or fundamental, but Tanantala are technical traders, but in some cases they do align up, as Tanantala was justly explaining. But reasons, of course, that fit within your trading plan. But it's also good to put on your critical thinking cap and look for filters. We talked about filters already a while ago. I think it was last week or 2 weeks ago. We had a webinar where we were looking at what kind of filters could block a trade from materializing. So it's good to keep both caps on. One, trying to look for confluences, looking for reasons that could support a particular trade at that particular point, but also looking from the critical side, why would it not work, right? So if you find too many reasons, then obviously maybe looking for confirmation or looking for something else, maybe another currency, could make sense. So I'll just quickly go through these tools, because we'll go through a lot of examples on the charts. I think that's more interesting for you. But these tools, basically, this is what I use: trend lines, trend channels, moving averages, Fibonacci retracements, Fibonacci targets, tops and bottoms, supply demand, the oscillator, Camarilla, and the candlestick. So this is what I usually stick to regarding my tools. And for those of you who joined the live webinar trading, you probably recognize most of it. And this is more than enough information for me. So I'll just give you a few seconds to take a look if you want. But basically, lots of trends, trend lines, trend channels, the moving averages, fibs, logical support and resistance like tops and bottoms, right, and the oscillators and candlesticks, okay? But besides the tools, I also use patterns, right? We're looking at chart patterns, very important, bull flags, etc. Wave patterns, Gartley patterns, Fibonacci patterns, price action patterns, impulses versus corrections, divergences. I look at time factor as well, often enough. I find that pretty useful information. There's a webinar, in fact, on time factor. In case you missed that, it was one of the first webinars of this year, so you can find that in the educational section. So these are all kind of patterns that I don't always use. Obviously, there's not always a bull flag, so if there's not one, then no need to look at it. But occasionally, when the time is right, they all make sense to use when need be.
Yeah, also, beside those time factors and other signals, these are also indicators that are most eligible for finding confluence. And those are basically round numbers, especially 0, 0, and 50 levels. Then Fibonacci retracement swings on multiple time frames. Then we have MACD and or stochastic divergence, pivot points, but only weekly and monthly pivot points, consolidation and overbought or oversold conditions on higher time frames, trend lines, confirmation of a leading indicator and lagging indicator with support and resistance at the same time, candlestick patterns on important support resistance levels. And the thing is, there is no system that can give you the exact signal for a confluence. That is why trading confluence is not very suitable for beginners. First of all, you need to have some knowledge in order to use those things mixed together in one single sign for an entry. So basically, what I'm trying to say that indicators which we use for trading confluence are discretionary, and they're always discretionary factor, and you need to use your common sense. And now we get again to the topic about trading manual systems. Why do traders who trade only manual systems without any knowledge of the markets lose the money? It's because you always, as I say, need to have that inner or gut feeling inside of you. You cannot have it if you only trade automatic manual systems without any common sense. So it's the same thing with confluence. If you spot, let's say, hourly pivot point close to a weekly pivot point, and we can see that the price is consolidating around weekly, and we have, let's say, a lagging indicator which tells us to go short, and we are at the very top, then that's confluence of three indicators, and your discretionary factor, your common sense, will give you the cue to enter the market. So you don't trade PDF systems, you don't trade indicators, you trade confluence. And that is why me and Chris usually say, when we do analysis and basically we do trading, let's find a confluence around that level. And later we will show you what indicators you can find for confluence and how you can use it to your advantage, what you should take a note of. It's not very hard to do it, but you need to have a practical knowledge of chart patterns, of candlestick patterns, of divergence, of course, and other stuff. So that is the most honest opinion and the most truthful. You need to have prior knowledge of those factors to be able to spot a good confluence. So for new traders, it would be very hard. But for some traders who know what trend line is, who know what Fibonacci is, that is the thing to do. So the first thing, how to create Fibo confluence. First, we need to, that is the first step. First, we need to determine trend on higher time frames. Let's say we use it on intraday trading, so we open 4-hour time frame. Then we mark the swing points. As I told you, and me and Chris were having a webinar with you for Fibo drawing and charting, you always draw Fib from the left to the right. And let's say that this is an uptrend, as we can see the first picture. The first Fibo is in black color. I have drawn Fibo retracement for the most important swings, from the swing low to the swing high. And you can see that basically we have a black color down there. If we drop to lower time frame, we can see that also in 15-minute time frame, because as you know, we teach that if you trade 4 hours, you make entries on 15 minutes. If you trade 1 hour, you make entries on 5 minutes. Then we drop to lower time frame and we find swing points in the main trend direction. New Fibo, which I drawn from the last 15-minute swing, is in red color, okay? So basically what I did is mark the swings in the higher time frame, dropped to a lower time frame 15 minutes, then I mark the swings in 15 minutes in the trend direction. So if we are bullish, then we go from the lower bottom to the higher top, so from the left to the right. And we can see that the price has indeed made confluence around 38.2 main chart, and that is in between 50 and 61.8 on the lower entry time frame. So our confluence zone should be around 50 and 61.8 on entry time frame, because we have in between 38.2 on higher time frame. And you can see that this price has indeed respected that retracement and went upward for some 30 pips. So that is a confluence zone anywhere in between 50 and 61.8, because that lower time frame has aligned with a higher time frame. Okay, higher time frame has aligned with a lower time frame, and when you have an alignment of both time frames, then your entry can be called a higher probability entry. So that is how you create a Fibo confluence. Next thing is trend lines and Fibs. So let's say that we have the same example, but I just cut the picture. It's the same, very same example. This black line in the middle is 38.2 of that swing high. So we can also add trend lines, because trend lines work perfectly fine with Fibonacci numbers and with basically price action analysis. So then you can add a third line, a third confluence factor, which is in this case is a trend line, and you can see the first two touches are most important. So we zoom into lower time frame, that is 15 minutes. If we chart it on 4 hours, we draw fibs on 15 minutes, and we connect first two lower points and we rate the trend line. We just let the trend line go, so we rate. And then we can see that we have made our point there at the second point, and basically the third point, that is around 38.2 of 4-hour time frame retracement, and in between it was basically the same level for entry. So you see that the trend line is, it has one touch. The first touch is where we connected, second touch is over there, and basically the third touch is almost at the very confluence of 38.2 and in between 50 and 61.8. It's that particular swing on 15-minute time frame that has given us a nice confluence, and that line just added to that confluence. So that we call a confluence of higher time frame, lower time frame, Fibo number, and a trend line. So it's a triple confluence in this case. And you can see that in this particular example, the trend line was perfectly respected. The price went to almost to the test, but it has never broken it, and only after a period of a markup trend we can see that the price is consolidated around the tops. So that is how we can create confluence with Fibonacci and trend line.
Great stuff. We're going to take a look at some examples. Actually, it ties very nicely into what you're saying, T, is that I have here trend lines too with Fibonacci retracements, trend lines with moving averages, or trend lines with tops and bottoms. Often enough, moving averages are great for breakouts, but the disadvantage is that sometimes price just peaks or punches through a moving average or a group of moving averages, but then it doesn't get any follow through. So the advantage of a trend line is that you can connect those particular points, and that break of the trend line should get more follow through. But you can. These are just examples of combinations. Basically, you can really any of these tools that you use, you can combine them. These are tools I use, so I'm showing, of course, combinations of tools that will make sense in combinations that I would use. But it really depends. I mean, if you're used to, I'm not necessarily saying that you have to use the Awesome Oscillator plus a moving average break. That would be something that I would use, but you could use the MACD or the RSI, for example, plus a trend line. This is just to give you an idea, of course. These are not fixed with each other. But often enough, I do like these particular setups, like the Fibonacci retracement plus a target, for example, often very strong. The pound-dollar short that we looked at in the trading room from 161.40, I think it was, with the 15 pip stop loss, is a good example. I think we have it later on, actually, a screenshot of that. Trend lines are always good, right? So, etc. So basically, it all boils down to multiple tools, multiple patterns, multiple time frame analysis to get that confluence between your charts, and to judge if you want to trade very discretionary or you have semi-discretionary with the strategy, but still use your own judgment. Then finding this confluence in times that your strategy might give you a signal would be good. Right? It will give you that extra confidence also maybe to pull the trigger and also have the discipline and patience to stay in for that ride and trade. So finally, some charts. Here are, from my side, here's the Euro-Dollar 1 hour chart, and basically moving averages, fibs, and trend lines, and the oscillator, right? And this is Euro-Dollar downside back in the summer of this year, and 1 hour chart. So obviously, moving average is showing that it's a downtrend. No doubt about that. We were an uptrend, but we broke any trend line here. We punched through the moving averages and are now using the moving averages as resistance for that downside. Every time we go up, we find resistance and move lower. So some confluence obviously is these three moving averages. First of all, you can see when price got back here, it was resistance, and when we broke, that was the confirmation. But there's also some confluence between, for example, the fibs and those moving averages, and also fib targets, right? If we fib from A to B and look for the hook back, because there was maybe some divergence between these bottoms, so therefore we could expect that bigger retracement like this, another confluence. Not necessarily do you have to buy here, but there would be an extra confluence with these targets together with these fibs at the long-term moving average for reasons to think that plus this resistance that there could be a probability of downside, right? Same for this retracement. So that's one way of looking at it, and all these breaks were good to go. Now then we got a pretty actually a hefty spike up that was, I'm pretty sure, NFP or probably maybe even FOMC looking at the date. Very volatile, very impulsive move up, turnaround of trend, wouldn't you say? At least that's what I would think, but I'll leave it up to you. I'm showing to you a blank chart on purpose so that you can take a look and say what you think you see in this particular chart. What elements would you judge important when looking at this particular setup now? What do you see here? What things would you put on the chart to make an analysis? Of course, you cannot change the indicators that I already have put on the chart, but maybe you can say I would add this or I would use this. What do you think? And then after this, you will see my my screenshot, what I came up with. So we got a first answer. Pivoslav says triangle. Triangle. Does anyone agree? Is there a triangle there? Or do you see something else? Jose sees a flag. Good. Good answers. Great stuff. I'll just maybe wait a few seconds still if anyone else is. answering something. Roshan is saying a wedge allows us a channel down. It's always interesting to see this, and it just shows that we have 5 answers, and they've all been different so far in a way, I guess, except Moga and Jose, who both said flag. And Moga said specifically bull flag. But otherwise, all these answers have been just a tad different, so that's always funny to see people traders look at one chart and then see all these different elements in fact. But Viganta says supply and demand. Great stuff. Well, I guess I'll move on to my chart then in that case. Thank you for all your answers in fact. And I think all of them make a lot of sense to me. The triangle, yes. The flag, to me, it definitely looks like a bull flag. It's definitely a consolidation zone, and we can debate if it's a flag or triangle or wedge. They all have merit, in my opinion. Looking at the lines, I probably would have think that it's more like a bull flag maybe, but it's a small difference really. It's in any case all a correction, so that was all perfectly done by you, and it's also a 50 fib off of the moving average, right? The long-term moving average, and obviously it's a very strong impulse with the oscillator reaching out to the sky. So when the oscillator does that after a first turnaround, the likelihood of a break of that top is very high. More on that maybe in the oscillator webinar that you can find at Admiral Markets webinar archive, but that likelihood is very high. And the break didn't happen very fast. Yes, it was a slow methodical move to the upside, but it did happen, and price neatly, well not neatly, yeah, choppily moved up around this band, made a bigger trace, but eventually did move up and make a channel to the upside. And so that would have been my analysis here, and this was the result basically. This is pound dollar 30-minute chart. And this was the example I wanted to use because it was a recent example, but also one we discussed in the trading room, in fact. And I had a pending order at 162.40, I think it was, no, 38, and the stop loss was at 162.53. So it was a 15 pip stop loss here, and it was selling basically it's selling the 886 fib and the minus 618 target, or minus 272. I think I had a fib actually from here to there when we were doing this live, and there was a minus 618. So this screenshot is a bit incorrect. The fib I had lower, and there was a minus 618 there. But anyhow, there's even if you fib the first move up, there's a minus 272 as well. So you can see the price moved down to the 786, then corrected up to that target. It was a very small risk and big downside. I don't know if anyone took that trade. I exited around 160.80, but you can see it went down a lot more. In fact, no, yeah, no, this is, sorry, 160. I think I'm getting it mixed up. Now I'm not sure anymore. Because I sold it here, in fact. Excuse me. This is a different example. This was the example we took in the live trading room, where it was 160. I can't see the numbers. Anyhow, I took it to about 159.80, in fact, somewhere here. It dropped a bit more, but then we did get a bigger retracement. That's because there was a daily bottom here. In any case, the point is the same, that you can see how the fib retracements and targets line up just like they did here. In fact, minus 618 right near resistance, and the trend line, trend channel indicating that downside. So you got moving averages, trend channel, resistance, target, Fibonacci retracement, top, all of that, impulse here, correction like this, to make that judgment with these tools. Breakout, 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 right? So this was, I was talking about the real life example that was actually here and not there, but that was the trade here, and took it out. I actually took it out right at this bottom here, but then it broke and made another fall, but doesn't matter. It was still a 5-to-1 trade. That's a good R2R. And you can see the funny thing was that a lot of people were here bearish in this correction, and I'm going to explain a bit more. In fact, I have information that the Forex trading community of where 75% of the traders were actually net short in that zone here, where you have the green, red, green. That was information I read on through Skype from a trader. I don't know where he got that information from, to be honest. Forgot, but it's a reliable person and source, so I fully trust him, and I'm sure that's true. And they were short in this area, and 75% of the traders were short there. And you know, obviously they saw that the downside, right? And there was some down momentum, so there was reason to think of shorts. Like we could see that shorts in this area proved appropriate. So why did a short not work out here that much? What's the difference with this is the question, right? Now, if you take the contrarian view, that the fact that maybe that so many people are short, maybe there's already reason to think that shorts are not too good, but that's not good enough for me necessarily. I think that if you look at the daily chart, you can obviously see why there was reason to think that that could be a bouncing area. If you look at the daily chart, we can see that there is a potential for this to bounce off this daily support. Remember, daily support like that, or weekly support or resistance, is not broken usually in one go. If you make a fall like this, usually you get a kickback before you have enough energy to push through a level like that. The market usually doesn't go and break such a key level without some resistance or some pullback or some bounce. And the market knows that, and the psychology of the market is geared towards that, right? So basically you won't have anyone shorting here to push it through, right? I mean, really big institutions. Maybe the net retailer, but they probably don't recognize that this is such a support that easy to break. Maybe, I don't know why. All right, but this was definitely a support that we always have to be careful of a daily like that. And if you would have gone maybe to, for example, the wave analysis, small promotion for my wave analysis at Admiral Markets, I hope you don't mind, but this was a screenshot actually, as you can see from back then, from the 2nd of November, where I post my daily morning analysis once a day, and you can see the wave count here and giving a nice 1, 2, 3, 4, 5, and already indicating that I don't think necessarily we have to expect a break here. We could definitely get an ABC. And if we then look at what happened, no, we have to go back for what happened. Then you can see that's exactly what happened, in fact, right? And actually, we got one more break up, two more breaks up after this, up, up. Then we got a correction, and most recently the pound dollar fell back to the support line, bounced off, back down. So it's now in a wedge, in fact, like this. So that's what happened after that. So you can see the full picture there. But even this break here was definitely in the cards when we had a support fractal above the band, making a triangle. That was definitely in play. This was definitely a news spike that caused it, but then again, it was also technical because we broke out of this trend line. And one of the reasons, as you know, that I said live in the trading room was that looking at this particular impulse that went all the way above our band, I think that's a very bullish sign, personally, of an impulse. And this is looking like a sideways correction. I expect actually correction to the upside, looking at this impulse. So that's one of those, and the break above the moving average. So that's a confluence of analysis using impulse and the moving averages to make that judgment, right? So that's the confluence there, using multiple things. So, well, anyhow, of course, a bit of luck is needed. I'm not saying that I'm perfect. Sorry about that. It wasn't intended, but it was said during a live trading room. And just want to explain, it's important to keep an eye on a daily support like that in conjunction with moving averages and an impulse and correction like that, to understand that maybe we shouldn't be shorting here, right? Or we should be careful at least and not trade it, or if you want to be a bit more aggressive, maybe go long. So that there, I was really surprised by this number, and I thought it was really a good indication in this webinar with Confluence how it's possible that 75%, so many could be net short right in front of a support like that. That kind of threw me off. I was a bit surprised, but so that was the explanation why I wanted to give to you. And that wraps up actually what I wanted to share. Jonathan's going to go further now with the MACD divergence.
Yeah, MACD divergence. Thank you, Chris, very much for a lovely introduction. And for this webinar, we have, of course, charted a lot of charts for today, and this is especially important for the Confluence setups because we need to chart it by ourselves. It's not very practical to use just indicators for finding Confluence levels. So we will go step by step in this example. It's MACD divergence and candlestick patterns. The first thing is, and this is as far as this is as far as I remember, cable chart, and this cable chart served an excellent example because it happened a few days ago. And what do we see here? First, we determine divergence on higher time frames. It's a 4-hour time frame, of course, for intraday trading. Then we mark important support and resistance levels, or use pivot point indicators. As you can see, those are my red lines on cable. So I don't have any pivot point indicator, but you can use, of course, pivot point indicator. More or less, it will be very accurate. Then we need to spot the divergence. As you know, this is regular bullish divergence because we have the price making a lower low and oscillator is making a higher low. So this is, when you see this pattern, this is regular bullish divergence. Now I need to see whether this regular divergence is close to my red level, and indeed it's close. It's some 20 pips off my red level, but I can find it that is also very close to 0-0 level. So basically now I have a confluence of 0-0 level. I didn't mark it on the charts, but it is a 0-0 level, whole number, okay, and divergence. So we have whole number, divergence, and we have also we are very close to our red level. If you remember our previous recap, that was after this move, I was telling you to go long in between 50, it was 59, 50 I think, and 53, and to put stops around 58.80 with 60-20 target. It went through the target almost to 61. So basically this is why I use that stop loss 58.80. It's a good level. So regular bullish divergence, good level, and 0-0 number. Next slide will show you basically now what we do as a step 3. Find the reversal candlestick pattern near the bottoms. As you can see, the bullish divergence went perfectly well, very close to spinning top. Spinning top is also an important candlestick pattern which indicates indecision in the market. But if the body is very small, like in this example, it's a stop candle. So this is a stop candle, and it's very close to red level, it's very close to 0, and we have regular bullish divergence. Regular divergences are those divergences who make the trend change. They are game changers, okay? They switch the trend. So we either make a new position or we exit the position. That is sign of regular bullish divergence. Then we have spinning top, we have 0 level, and we have 58.80. Okay? Next slide. Can we find another confluence point? And we can. It's a falling wedge. This is a falling wedge. It's a bullish sign. And we can see that after this candle closed, next candle basically break out through the wedge, went above 59.50. It's a red level, it's a whole number. You see the reaction at 59.50, consolidation, accumulation prior to markup, and we have markup trend, then that is distribution. Usually accumulation phase begins in Asia session, then we have markup and distribution, which usually happens. London collects usually is collecting stops prior to London Open. So sometimes we have that Frankie fake that is collecting the stops prior to markup and distribution. So basically you can see that all on the charts. These are all signs of a confluence. First it was a nice down trend. Then we didn't have a substantial retracement. Then we have noticed bullish divergence, the first sign of sellers weakening or exiting the position. That is the first sign, divergence. Then spinning top candle, stop candle around 0 and red level. Instead of red levels, you can use pivot points. Then what we do, we of course notice the wedge. So when this spinning top candle closes, we can trade it safely. And you see the reactions, 59.50 consolidation, distribution, uptrend, and again consolidation with stop grabbers, of course. Stop grabbers. Why stop grabbers? Because this is today's example. Well, this was a fake move, obviously, on cable, because all of cable news went perfectly fine. This was just initial reaction to rate cut which was happening on euro. So it was basically dollar strength, and you can see now that cable is going steadily to the upside. So yet again we can see how the price reflects traders' decisions and how confluence can give us a psychologically it will strengthen us to make the trade. So if you ever spot divergence, spinning top candlestick, close support resistance level, go blindly. There are few times in history when such perfect setups have been spotted. Okay? And this is one of very nice examples. For such good confluence, we need to be patient. Next slide will be also a confluence, but it's indicator confluence. And this is particular trading strategy which uses Bill Williams indicators such as accelerator and awesome oscillator. And this is one of my favorite 4-hour strategies, of course. And of course, as I say, confluence works wonders on higher time frames. We don't use it on lower time frames. So first we need to find a trading strategy specially suited to higher time frames and use confluence of indicators. This strategy, now we will not bother with this strategy particularly. We will just explain how indicators which are great for a strategy can be aligned to create a confluence. So the rule of thumb is to find a confluence of indicators for strategy rules. So if that strategy is, the first rule is to trade it on higher time frames. The second thing is that the strategy needs to have a leading indicator, lagging indicator, entry indicator, as we have learned through our webinars. And we can, of course, and we should have at least one dynamic or one static indicator for support and resistance levels. In this example, we use static pivot points, and we use, of course, a couple of Bill Williams indicator, which can be also combined into one single window, but I have created two windows just to show you the example. So this strategy basically says if PSAR or PSAR appears above the candle, then we should be ready to find another alignment points. Accelerator should be red, awesome oscillator should be red, and stochastics should not be below 20. So basically, then we make an entry. Entry is PSAR only if it supports the confluence of indicator factors. So we don't use stochastics for entry. In this trading method, stochastics is only used to sign for overbought or oversold conditions, nothing more, nothing less. So it's just a sign of overbought and oversold, nothing more. We have an entry indicator, which is PSAR, and we have a leading and lagging indicator. In this case, leading is accelerator, lagging is awesome oscillator. And we have made a perfectly fine strategy on higher time frames. So only if those factors are aligned at the same time, we make entries. We don't use add-ons in this strategy. We wait for alignments. That's one of most important aspects of confluence trading. When we spot a confluence, that is our entry. We make our entries based on confluence. So later it's hard to find add-ons. We can scale in, scale out, but that is very, very subjective and discretionary. Usually those confluence trading indicates the first and very first entry in the market, be it your trading method, trading strategy, or trading systems. Yesterday I explained difference between trading strategy, a trading method, and a trading system. Okay? Trading method is, of course, most advanced knowledge you can ever have. Then we have trading strategy, and the last but not the least, trading system, but that is the very basic for trading. This is a trading method because it uses a confluence of factors, and it's solely used on higher time frames such as 4-hour and daily, but this strategy is suitable for 4-hour trading. So that is when we have indicators confluence. And now last I have marked a confluence of fundamental and technical analysis, which we will see on the next slide. We will see a nice confluence of technical and fundamental analysis, and this is it. If you can see what happened now, the chart speaks for itself. The chart speaks for itself. We have first we need to open a higher time frame prior to strong news such as ECB, FOMC bid rate announcements, conferences, or NFP. We don't use it for not big news. We just use it for strong news events. Then we need to find a pattern on the setup chart such as a rising wedge. It was a rising wedge on 4-hour candle or 4-hour chart. We have a perfect consolidation and a rising wedge that signals a potential breakout to downside, because rising wedge is bearish pattern. Okay. Then we can see that we can trade a pattern if it's in agreement with the news. So after ECB cut the refi rate, what happened is it went from 35.15, which is again a confluence with a lower part of the wedge, and what happened is it made, I have made the chart. By the time the candle was forming, it was a leaving candle, and now when I open 4-hour time frame, I can see that this candle is not a bullish candle because it retraced almost 50% from the lows. It went to 32.94 and then the candle closed at 33.80. So basically it was not a bullish candle. But let's say for showing purposes that this candle is a bullish candle, just for showing purposes. What could we done is we probably could have made a trigger happy entry, okay, just at the very first breakout without any retest. Well, basically that was that. The candle went through the lower part and went through all the levels to the bottom. But if it was a bullish candle, we should wait for the candle to close, then try to enter if on retracement, if there is any retracement. So we mark from the top to the bottom, and then we wait for retracement. So basically there are two things you can trade: fundamental and technical confluence. Find a pattern, enter a trigger happy entry. We already explained what trigger happy entries are, and then we can wait, or we can wait for the candle to close. If it's bullish candle, we can try to find a retracement. So that is a nice example of fundamental technical confluence. As you remember, we also did some nice examples of NFP trading, which me and Chris may have again. We may make it scheduled again, because many traders asked for us to repeat webinar, to make a new webinar about NFP and to show how we trade NFP. So maybe we will make it again. So what happens is basically is that if fundamental and technical confluence, if there is fundamental and technical confluence, we should try to exploit it, because usually those are explosive moves, those are extraordinary moves, but also those are very, very risky and very hard to achieve. Just imagine a trader who just prior to the news shorted, because there was that split second in which he could have triggered the short trade. He would have entered around 35, and then the price would have dropped some 100 pips in half an hour. So basically it's very hard to trade at perfect confluence, because it usually happens at a news release. Just at that split second it happens, and if you watch the charts, the trade has already gone. So sometimes it's very hard to jump into the train. So basically we should then wait for a particular drop or rise to appear, and then trade if that candle is bullish candle or white or black Maribozu, it doesn't matter. Those candlestick patterns are traded by themselves, just by retracements, because they are master candles, mark the very support and very resistance. So anything in between that is void zone. So for this, now we will conclude this webinar just saying that 35.15 and 39.42 are ECB levels, and those levels should be very strong. So they should be very strongly supported. As you know, FOMC candle proved a nice support, a nice resistance. Now we have ECB candle. That ECB candle now is resistance and support for itself. That candle has marked new levels of support and resistance, important levels. As you can see, I had 35.15 on my charts, and I had I didn't show. Let me see what was the lower level for red level. It was 35.75. Okay, my level is 20 pips lower than 32.94.5, but it doesn't matter. So 35.95, 32.95 and 35.15 are important levels of support and resistance, which are marked by those fundamental and technical confluence. Okay, mark it on your chart. Now, if you have any questions, you can ask us. If you have anything to add, Chris, now is the time.
No, that was great. Very nice. I think we both used that. That was the pound here, right? That you used. Yeah.
Yeah, the pound.
We both used the same example, in fact.
Really? Yeah, indeed.
Uh-huh.
Falling wedge, exactly. Regular bullish divergence, falling wedge, and candlestick pattern, spinning top.
So let's see if there are any questions.
Usually, when we spot those confluence, so strong confluence, those are blind trades. So we go blindly into trade. Just jump in and let's see what will happen. Usually, those things are very, very tradable.
So that was the trading confluence. Now, don't forget to take a look at Admiral Markets' website and take a look at the spreads, for example. This is typical, so if you want to know more about that, I definitely encourage you to take a look. Next week we'll have a bunch of webinars again, in fact, starting with Monday, taking a look at the webinars. I think it's the odd USD, pound USD, EURD recap, right, on Monday?
It will be a recap. It's basically 4 pairs recap. It's Euro, Dollar, Aussie, and Euro Yen recap on Monday.
Oh, Euro Yen, okay, cool.
Yeah, I just included Euro Yen, and maybe in later webinars I will see, maybe I will include some other currencies such as Aussie, New Zealand dollar, or Aussie Japanese yen, or CAD yen, something like that we will see.
Ah, cool, very nice.
Yeah, thank you.
Very nice. And then we got live trading sessions. And then next week, of course, we have our own webinar. I'm not sure what the topic is. Let me check. We can go to the website together. If you want to register for that, just go to education, go to webinar. And we have how to plan your trades is 14th, that's next week. And then the week after, we've got we have Fibonacci for beginners, sorry. Fibonacci for beginners, and then on Tuesday we have moving averages.
Yes, that will be also very important to show you why you shouldn't trade those crosses just simply, and how you can use the moving average to your advantage. So if you don't have any further questions, we can conclude this webinar. So guys, as far as I'm concerned, I'm very happy to see you in such nice numbers. Thank you very much. Thank you very much for attending. Thank you very much for paying attention to. And I wish you many green pips. Tomorrow we will come with new analysis, new trading setups. Be very careful about markets. Tomorrow is also NFP. So don't try to overtrade. Be very careful. And we will see you very, very soon. Thank you, and have a green pip weekend.
Yeah. Thank you also so much for being here, and wish you all great trading and a good weekend indeed. Talk to you soon. Cheers.